Welcome back to Wall Street Week. We're joined by Keith Banks and Rick Szelc. The election is overshadowing so much of what's happening in America right now. Keith, I know you guys just did a survey with your client base.
We did.
How important was the election in terms of people thinking about the economy and their investments?
So it's actually a survey of non-U.S. trust clients, but wealthy individuals. It looms large. So interestingly, among business owners, the election was the #1 concern on their minds as they think about the future. More generally, people are actually optimistic, thinking that the election would bring about positive change, a positive outcome.
Is that something that you would share, that sentiment, as you're leading a company, a financial services business?
Well, look, our advice to our client base is that when you look back over time, interestingly, elections don't have a big impact on the broad market. They can have big sectoral impact depending on the policies that the new electee comes in with, but it doesn't have a sustained impact. So.
Rick, Jamie Dimon was on the show last week, and he said that the election is not going to have any impact. Doesn't matter if Hillary's elected or Donald Trump on the overall market. Remember that, Gary?
Yes.
So what do you think of that?
I do think elections have consequences. It's going to modify behaviors. And from an investor standpoint, it's going to make them either more nervous or actually more optimistic.
So, Rick, you talked about having to prepare now for what may happen in November. Let's talk about how you position portfolios in terms of what you want to do with asset allocation for your clients' objectives, which is preserving wealth and growing wealth.
Gary, great question, because that's all that really matters, right? All this noise, what goes on globally, we can't control any of that. An investor can't control.
So this is the show for long-term investing. I come to you, what do you tell me?
The way I look at the whole investing landscape is how much do I want in growth and how much do I want in income? Where do I get yield? And yield acts as an insurance policy against changes in changes that could come. So today we're more defensive. We're more invested in a variety of different investments, and I would say we're looking at a 40 to 50% allocation to yield and maybe on the balance on growth, because to Keith's point earlier, the S&P at 17 times doesn't create a lot of optimism.
What sectors do you like, Keith, specifically?
Well, we think what's going on, and we share the sentiment, is a rotation out of growth into more cyclical, value-oriented sectors and stocks.
This late in the cycle, we're going to go with cyclicals.
Yes, and you can see the relative performance is reflective, and we think it's going to accelerate as we move forward. So we like areas like financials, energy, we like industrials, materials, again, consistent with that theme of cyclical and more value.
Well, then you can't expect a recession in 2017 if you're moving into those spaces now.
No, we're not. As I said earlier, we think we could see another 2-3 years of growth. In fact, if we were to bet today, we think this could rival the longest expansion, which was 10 years in U.S. history. So,
You know, we opened the show saying that 8 years later, it's still about the Fed every day. And what they say and how they tweak their commentary in terms of what happens with the markets.
Fed-centric world.
So if you know that's the case, how do you advise clients to think about the commentary every day in terms of a long-term strategy?
Well, again, we try not to get hung up and allow our clients to get hung up in what I call the data point du jour, which is good data point, bad data point, market up, market down. We have a strategic asset allocation, #1, and then we'll tactically adjust it.
Do you think
which
clients
we just did.
get too nervous? You said they were going to cash in the first part of the
They were asking
year.
about going to cash,
So
right?
do you think clients get too nervous? Is there a message out there for your clients about being long-term and being more patient?
Yeah, again, our view is you cannot zig and zag and think you're going to make money. It's impossible. We have no insight into that. They have no insight. Our job is to keep them on a longer-term course. We're comfortable tactically reallocating. As I said, we just went to a more neutral stance versus equities. But if the market were to pull back this summer by 5 to 7%, we would go back to an overweight position.
I think personally, Gary, this is a huge reason why people need the services of you guys. Is
Absolutely.
To calm people down and get them trained to think about this stuff way long term. The market is a voting machine in the short term and a weighing machine in the long term. That's a great Warren Buffett aphorism.
You know, there's a lot of things that you can do yourself. We're in that kind of economy, we're in that kind of world. But as I know, and as actually the four of us know, when you start thinking like in January,
Gary
February,
gives himself his own haircut, though. I know he's doing that by himself.
Well, it's better than paying $500 for this one, man.
That's cheap, man. $7.95.
But it is true. When you have those conversations with the clients, It's the kind of thing, some call it hand-holding. But, Rick, I've been there. I see how you do it. How important is it for the viewer out there to understand, because we're going to have volatility this summer, to stay the course? It's huge. Emotional changes that clients feel or want to make usually end up not delivering in a positive way. If you look at fund flows... 8 out of 10 times, 9 out of 10 times, you've been doing this for a long time. I don't have the statistic, Gary, but fund flows, if you look at fund flows from the investors, there's data out there that says if the S&P returned 9%, individual investors return 3% because they usually make decisions at the wrong time. So I learned this from a colleague of mine. I have a 3-call rule. And by the time I get a 3rd call where the person's really upset, then we make major changes.
All right, I hear you. All right, well, we want to thank you guys. Keith, thanks. Rick Szelc, thanks for joining us. We'll be back right after this.